before we proceed building the three-statement financial modeling, let's have some good understanding of what we are about to learn or do in the training today. So what is the financial modeling? So it is the process of using financial data, assumptions, and formulas to build a structured model of how a business performs and is expected to perform. So it's basically about projection, forecasting where you want the business to be, or projecting where the business will be in the near future. So building a well-structured financial modeling helps an accountant and business owner understand clearly the relationship between revenue, expenses, asset, liability, and the rest, because all this interplays while we make assumptions. So let's see some of the importance, then we proceed. So here are some benefits and importance why financial modeling matters. So provide a complete picture of business performance, position, and the cash flow situation. So it helps you identify the real cash impact of a business, which cash is a blood of a business. So it supports budgeting, forecasting, and financial planning. It also helps the management understand how assumptions affect future results. So that's that about this. So let's see some key benefits of financial modeling to an accountant. So better financial analysis and interpretation. You get more clarity or more simulation of what the business is. So any identification of cash shortage or funding needs. So it's all about clarity. It's all about simulating how you intend or what the business is. So that's it about it. Let's move on to the next. And find an income statement. So these are selected few, right? So let's scroll down. Let me show you some stuff. So right here are the assumptions. So but assumptions are better stated in blue. So let me format it right away, because these are numbers made through assumptions. So let me get them in blue. Right. So that's it about it. So all these items in the income statement are going to be forecasted using these assumptions. Right up here is organic sale. These are the numbers of people that are assumed or are forecasted to come to the shop and buy items. For instance, the 2026 is expected or is being forecasted that 3,000 people will come to patronize. Then by 2027, 3,005. You notice an increase. So by the fourth year that we are forecasting for is 5,000. So on that basis, the average or the assumed prices of the items that will be purchased is 4,000, right? And here as well is the amount of discount. Some customers, due to their patronage, are awarded discount. So the percentage is 3%, and the 3% will be a 3% of the gross sale. So let's scroll down and see some more. So right up here are the assumption for the expenditure of cost of goods. You notice raw materials is 20% of the gross sale. These are the basis of the assumption for this class. So one thing again you need to know is that you can actually use any form or any type of number. I just selected to use percentages because sometimes percentages are more precise and accurate. Though you can achieve it by using any kind of number that you wish, in as much you follow the pattern on how to construct or build three-statement financial modeling. So let's get straight and start immediately. Now let's forecast for our gross sales. So how do I do that? I will hit on here equal to, right, the numbers of organic sales 3,000 for the first year, then multiply by the average price per item. Let me hit it. That's that. So 12,000 naira worth of sales is what we're expecting for the first period. So this is an Excel. So it is smart and has a way it deals with things so swift. So how do we do this? There's what we call relative formula or relative function. So because of the fact we got this one right and formula is involved, so it will relate this all true, right? So that's that. Then for the next one is sales discount. How do we do that? We hit our equal to. So see the percentage that we are forecasting for sales discount. Sales discount is 3% of gross sale. So right up here is the gross sale. So we hit here. So let's put our multiplication sign right away and take away this unnecessary pop-up. So let me hit this. So that's that. So this is the amount for the first year for discount that is being forecasted. So right away it is. So because in finance, expenses or deduction is preferably left in minus. So we introduce minus sign so that it will be negative, right? So that's that. So I hit this. So now let me transform all of them to be negative. Absolutely right. So that's that. So we are expecting this sales and this discount for the period. So now let's add up and get our net sales. So I hit summation. Absolutely. So right, let me run through. Good. The top border. So that's that. So for the next one are our cost of goods sold. So we are starting with raw materials. Definitely we are forecasting on the benchmark of the gross sale, right? So the percentages are written down there. So I told you can either use any type of number in as much you follow the pattern for making this model. So let's hit here equal to. Then let's select our gross, right? So one thing important here is that we are using this particular one to run through this column, right? Because we have a couple of expenses here. So for the fact that we want to maintain this, so what I'm going to do is to make this thing constant. We call that absolute, right? I'm going to introduce absolute formula by using F4, right? So because I'm running through the column, right? So I only let the dollar be in the middle. So that's that. So because this thing is going to be constant on all the expenses. So I hit multiplication right away. So that's that. So let me select. Okay, this is the raw material. I hit it. Hit enter. Exactly. So good. So we just need to do it once, then the rest. The relative function does the what is remaining. Absolutely. So you see that. So what next? Let's just make it negative because it's preferably leave in negative form because this is finance. So we pull it out, hit our enter. Good. Let's move. So that's that. So what do we do next? Let's get our total cost of goods. So we hit from here and summation. Absolutely. So now let's get it straight. Right. So this is a total cost of goods, total direct cost forecasted for the 4 period of years. Right. So now let's determine our net gross profit. So let's do that by hitting equal to, right? Then our total sale plus, so let's take away this pop-up, plus the total cost of goods sold. Right away is our gross profit. Right now, let me stretch. Absolutely. That's right. So now let's take and know the percentage of our gross profit to our gross sales. Right? So how do I do that? I hit equal to, then our gross profit divide. Right? Let me take away this pop-up. Divide by our gross sale. That's it. So let me hit enter. See that? So 74% of gross sale is what we have as our gross profit. So let's make it bold. Exactly. So now let us move on to the next. Now let's forecast for the next. Let's forecast for our operating expenses. So how do we do that? Just as we did the cost of goods, right? So we hit right here equal to, because we have a benchmark of the gross sale, right? We hit right here. So remember, we are going to run through this column by this and this column by this particular one. So let's make it absolute. So how do we do that? You hit your F4, right? Then the next you hit your multiplication. So let's take away the 7 pop-up right here so that it gets normal. Absolutely. So now let me take right up here. Okay, right here is our first operating expenses item, the label. So if you get one right, absolutely, all of them are just basic. So right up here is our expenses on label. So let's drag. Absolutely. Good. So we have to make it negative because it's an expenses. So you hit your minus. Let me take away the pop-up. Exactly. Hit. Good. So let me hover and make all of them negative. Good. That's that. So now let's see our total operating expenses. I hit our summation. Is that 1.2 million for the first year on operating expenses. The next year 1.4 million, 1.8 million. The last year, which is the fourth, is 2,250,000. So that's that. Right away, let's determine our EBITDA. EBITDA means earning before interest, tax, depreciation, and amortization. So I hit enter. I hit equal to right away. So let me hit a gross profit, right? Then plus, take away the pop-up, plus our total operating expenses. Let's get it exactly. So our EBITDA profit is 7,680,000 for the first year. Now let's stretch out and see what we have in the next. Exactly, we're having 14 point something million at the end of the period. That's EBITDA. So now for our depreciation and amortization. So right away, let's make an highlight because we're going to solve for this when we determine the numbers of assets we're going to use for the period. So I will highlight here so that we don't forget. So what's next is our EBIT, right? Earning before interest and tax. So how do I do this? I hit right here equal to our EBITDA, right? Then minus, plus, because our expenses we put them in negative. right away. So let me take away this negative pop-up, right? So plus here, so it's an empty space, but when we drop our expenses on depreciation, it will populate itself automatically. Let's hit this exactly. So now let's stretch out and have answers. Absolutely. So the next we have down here is our interest. So interest is the amount of financial cost or finance cost on long-term borrowing or short-term, whichever case it may be in this regard. So how do we do that? Okay, can we sort out for that now? So let's highlight later we do that. Sorry. Then for the next one is our EBIT, earning before tax, right? So how do we do that? We hit right this place, equal to, let's select our EBIT, right? Earning before interest and tax, right? Plus, let's hit our plus. Take away this pop-up. My keyboard is having issues, but I'll manage that. Then hit right at the interest spot, then hit enter. Good. So by the time we have here populated, we have our definite answers. So that's that. So for the tax, we still determine our taxes. So taxes is 20% of this. I think we have to do it right away. So we hit right up this place, hit equal to, then hit EBIT, right? So let's see 20% of the EBIT. Let's put up multiplication right here, take away this negative pop-up. So now let's select the percentage of our tax right down here. Okay, it's up here, then hit enter. Wow, that's that. So this is the amount for the tax for the first period, 1,536,000. So let's stretch and see what we have in the subsequent period. So that's that. So that's that. So for our gross profit, let's make it, for the net profit, let's make it negative. So make this negative. Take away the negative pop-up. Hit enter. So now let's move and have it another one. Good. Now our net profit is, put up this, equal to EBIT plus, take away this pop-up, our taxes. Hit enter. Good. So this is the profit we are expecting, though by the time we populate our interest and depreciation, definitely we have a reduction right up here. So this is that for this. So this is the basic way we make our forecast. So you can see that it's way easy as you just see it. So right up, what next? We move to the next, the balance sheet. So you can see our next worksheet. So here are the balance sheet items. You can see right up here the current assets having cash, inventory, receivable, the fixed assets which are property, plant and equipment, in other words PPE. Then we have our current liabilities. Then let's move on to the next. So these are all items we are going to make forecast of using some assumption we have established. Okay, right away are the assumption. Okay, just what I did earlier. I had to make all these guys stays in blue because assumptions are better in blue right away. Good. So what next? Our cash. So the cash is not now. So we get our cash balances when we work for the cash flow. So right here, Snaply is a cash flow. So let's return and finish up this before we move to the next. So for the inventory, so let's see the percentage. So basically we are still using our revenue, gross revenue, to forecast these percentages. So right up here you can see the percentage for inventory, our receivable and the rest of the items in the balance sheet. So right up, let's get our revenue close, our gross sales. So I hit equal to, let me bring it right up to that sheet. So these are the gross sales. I hit equal to, right, let me stretch out. Okay. So let me move it. It's meant to start from here. Good, that's it. So these are our revenue, gross revenue that we're making assumption with. So right up here is the statement of financial position schedule, right? So now let's get into it and make the forecast. So how do we do this? So as you can see, these are all items of the statement of financial position. But what's important is that we are producing the figures by the assumption we've made, right? Alright, right away here are our gross sales that we made actually from the income statement. Right up here are where we pick them from, right? We had to copy to the second sheet so that we don't have to return to make the forecast. So right up, let's get straight and run through. So for the cash, we're going to make it yellow because we have to solve for the cash flow before we determine the cash for the period. So for the inventory, we are getting it right away. And for your notice, this is 2025. We are actually forecasting from 2026 to 2029. So why is this 2025 here? This is here on the ground that some business might have been in existence, meaning that forecasting for 2026 to the next 3 years, it implies that you are actually having some balances, meaning that you've been in operation for the previous year. So definitely you must be in with some balances. But for this business, this situation, we don't have previous balances. This is a startup business from 2026 and projecting to 2029. So that's why we are having 0 or nil items right up here. So meaning that this is a new business we are forecasting from the first year. So that's that. So for the inventory, let's do that. We hit equal to right here, equal to. Then let's go down. So we select our gross sale, which is the benchmark for the forecast. So what do I do next? I have to make it absolute because I'm going to run through a particular column with it. So I hit F4, F4. You see that? So let me put my multiplication. I put my multiplication. Let's take away the pop-up caused by my keyboard. So right up here, let's go down and select the percentage of the inventory. So I select it, hit enter. So let's see what we have. So right up here is our inventory forecast for the periods. You see that? So for the fact that Excel is smart, so let me drag down. I'm having the answer populated exactly. So let's now sum up our current assets. So I click on summation. That's that. So let me drag all through. Good. So we've done that. Then the next one here is our property, plant and equipment. So basically we have to buy assets. A business operates with assets, most times fixed assets. So how do we do this? So we're still going to make forecast for it, but for now let's highlight and return later. So we move on to the next. So what do we have here? We have our current liability. So the items payable on earned income and wages. So right down here are the assumption. You can see them, 4% of gross sales, the second year 5% of gross sales. So these are that. So now let's hit equal to and get straight into it. So let's hit equal to, then our gross sales. place, then we have to make it absolute because we are running through get F4, F4. That's it. So let's hit our multiplication sign here. Let me take away the pop-up. My keyboard has issues. So let's go down and take the percentage of payable. So here is it. I hit enter. Yeah. Getting this right, absolutely everything will go right. So let me scroll down this way. That's that. So let's have our total current liabilities. Let me drag from here, hit our summation. So that's that. So let me drag all through. Good. So let's move down to the next. So for the next one is our long-term debt. Definitely we have it forecasted already. So definitely businesses take loan from the bank, long-term, short-term or medium-term, in order to facilitate or enhance their operation. So let's see what happened right away. So let's go down and see what we have. So for the forecast of this business, the long-term debt projected for the first year 100 million, right? None for the second year. Then the projection of another loan is 500 million in the third year, right? So the repayment plan is 303 million each year. That's fantastic. All right, so let's get into it. So the amount of the interest, let's hit here. Interest is way low, 0.02%. That's why it's basically showing zero here. Unless you hit on it, then you have clear view of it up here. So now let's put up our long-term debt. So how do we do that? We hit right up here. We get to equal to, right? I told you about the previous years, right? So that this thing will work out well, because there's a way you run three-statement financial modeling. You have to maintain it so that you have the right thing at the end right away. So how do you do this? You select the previous years, right? That's assumption that probably something was last year, but there wasn't anything. So how do we do that? We select last year plus, right? Let's take away the pop-up. Then plus this year's loan, right? Exactly. Then minus the repayment amount, which is 3 million. We hear it. So we hit it. So that's that. Let's see what we have. Absolutely. So these are the amounts. So I stretch. Absolutely. So now let's move on to the next. So let's have our total long debt. So I scroll down here. I hit summation. So that's that. So right now, let's move to forecast our equity. So we have common stock here, we have retained earnings, right? So let's get started with the common stock. We hit here. Let's go down and see what we have. So the projection for the common stock is 60 million, right? The injection of capital into the business per start for each of the period is 60 million. So how do we do that? Let's hit equal to. Let's hit equal to. Then let's select face year amount. Let's hit enter. So that's that. Now let's stretch forward. Absolutely. So for the retained earning, we have to sort out that for. So now let's highlight so that we don't really forget. We have to do that. So that's that. So what next? Let's sum this. This plus this will give us our total equity. Let's sum right away. So by the time we populate the retained earning, the figure will definitely adjust. So that's that. So right up here are total liabilities, so we can actually do that later. So as you can see, we run through almost half of the whole job we have to do today. So we have cash to forecast for, the property, plant, equipment, we need to sort it out, and what again, the retained earning, and also some of the items at the income statement. So you can see right up here the depreciation and amortization we have to do for that, then the interest on loan. So let's get into interest on loan first. Right up, let's produce the number for our interest. Here is the percentage of the finance cost. So let's click. So we are having 0.02 percentage. Is way low. For the sake of this training, now let's head to balance sheet at the assumption point. So right away, so we hit our equal to, then let's select our long-term debt for each of the period. Select here, then let's multiply. Let's hit on our times, taking away the pop-up. So let's tick on the interest rate. Let's hit exactly right up here. The rates or the amount for the finance cost is 19,400 for the first period, which is way low as an expense. So that's that. So we have to populate that on the income statement. So right up here is the interest where we impute our finance cost. So I hit right up here, equal to, so let me bring it from the assumption on the balance sheet. So right up here is the amount, hit. So now let me take it forward. Good. And by the way, this is an expenses. It's meant to be negative so that it will cause a reduction on the revenue, as the fact is a finance cost. So I hit minus. So take away this unnecessary pop-up. Hit equal to. Right up, you can see that there's an adjustment already. You can see that. So let's take up the field. Alright, so at the income statement, we just have the depreciation and amortization forecast left. So right away, let's move on to the next. Go to our balance sheet. So for the moment, we are done, unless the one we had to sort for at the schedule. So right up here is the schedule. So let's see some of the items. The fixed assets the business is proposing or projecting to acquire in the period. So right up here, the first thing we are having on the schedule sheet is a property, plant and equipment. So the item listed is machinery and computer. These are the projection for the first year. They intend to buy machinery for their production. Then the second year, by 2027, they buy a computer. So no intention of buying anything in 2028. Then the last year of projection, you are buying a machinery and also computer. So that's that. So what do we do now? Let's add up the item purchased at the each period. So we hit our summation. That's that. So let's roll through. So for the first year, the intention is buying an asset of machinery worth of 2 million, and subsequently you can see what we have here. So what next is the depreciation, and if you can see right up here, the depreciation is by straight line. So we are dividing the book value by the lifespan of the asset, which is the duration is projected or assumed to be 4 years and 3 years. So now let's put up the depreciation schedule. Right up here, let me type depreciation, let me have it in capital, depreciation. Exactly. So now for the van, no, we are not having van. These are the two items rather. So I'm taking away this. So the plan is buying two assets, the machinery and computer. So right up here, I hit equal to, right? So we are forecasting for the depreciation of this. So I hit this, right? Then I'm making it absolute because I'm going to run the same because this is a straight line kind of depreciation. So the value of the asset is divided according to the lifespan of the asset. So I need to run through consistently. So what do? I hit F4 right once, then divide by the lifespan. I hit my divide sign. Now that I hit my division, so take it with the pop-up, then the lifespan, which is 4 years, I hit it, and also make it absolute. I hit F4. So that's that. Let me hit enter. So as you can see, so the amount for depreciation for each year is this. So now let me stretch forward. So right up here, we're expecting to expand it by 500,000. So, but if you notice, at the 4th year, there was an acquisition of another asset, right up here. So let me make it formatted. Let me hit this. So there's another projection of acquisition of assets worth of 1.5 million. So right up here, because of that, I have to include it here. So how do I do that? It has to be depreciation of this and depreciation of this as well. So I'm going to add plus here, and I hit on plus. Let me take out this pop-up. Plus which one? Plus this asset. Then I hit F4 to make it absolute. Then divide by the lifespan. Then I hit division sign. I'm taking away this pop-up. Then divide by the 4 years period lifespan. Then I hit F4 as well and hit enter. As you can see, so this is the amount we are expecting. So this is the depreciation of this asset and also this one. So that's that. Let's move on to the next. The next one is computer. So we are depreciating it from the 2nd year which it was bought. So how do we do that? I hit here, right here, equal to. Then I select the asset amount 300,000. Then I hit F4, divide. Let me take away the pop-up. By the lifespan, 3 years. Then I hit F4 to make it consistent. F4. Then hit enter. That's that. So that's the amount for the 3 period, 100,000. And such as the way we did earlier. So at the last year, there's an assumption or projection of another asset of computer, both of 300,000 as well. So we are adding it up here. So now I select this, put my plus. Let me take away the pop-up. Plus the book value of the new asset, then add my F4. Then let's put division. Division, take away the pop-up. Divide by the lifespan, which is the 3 years. Let's add F4 once again. F4, then hit enter. That's that. You notice we are having extra 100,000 here. So now let's have our depreciation summed up. So as you can see, for machinery, these are the depreciation and across the 4 years. So now let's add everything up from right here. Scroll down, then hit our summation sign. and let's just roll through. So that's that. So for existing assets, I told you earlier that this is a startup business, so there was no balance was available as the business commenced. So right up here is it, the total depreciation. So we are taking off this existing depreciation of some items. Then for this, let's head it up. Right up. So the next on the schedule is the property, plant and equipment. That is the PPE schedule. So how do we do that? First of all, you can see the narration we have over here, the beginning PPE. That is if there was any item at the end of the period of 2025, which we don't do with 2025, it will be a beginning PPE here, but we have nothing. So it implies that in 2026, there was no beginning PPE. So for the CAPEX means the expenditure on capital equipment or capital assets. So what we bought for the period, we go here. So how do I do this? Then for the depreciation, so we have the depreciation for the each period down here. So how do I do that? For the first beginning PPE, I put 0 because it was nil. Then the next one, the CAPEX, what was bought at that period. So let's head up, hit equal to, then select this offset, right up. Then for the depreciation for this particular year 2026, I hit equal to. So here's the depreciation. I hit enter. So it's an expense, so I have to make it negative. So I add minus to it. So I hit enter. So that's that. So let's add up. So let's get the ending PPE. Right. So 1.5 million is the net book value for this period. So the ending PPE here will be the beginning PPE here. So how do I do that? Hit equal to right here, select this, hit enter. So that's that. And for this, we have already established the formula. So now let's populate code. So for this, we already established because it's a relative function, right? And for this, we've already done it as well. Then for this, we've done it as well. So now let's observe it. So right up here is the CAPEX expenditure for the year. Here is it. Then the second, which is depreciation for the year. Here is it. Then the net book value, which is the ending PPE for the period. This is 1.5 million. So it starts as the beginning PPE for next period. So that is what we are having right up here. Then for the next year, we are having the CAPEX expenditure on assets right up here. Then the depreciation is here. So we are having net book value of 1.2 million. So it starts the 2028. So that's absolutely that. So let's move on to the next. So we are having retained earnings schedule right away. So now let's do about that. So like I said earlier, beginning means the balances of last year. So definitely there was no balances because this business is a startup. So for the beginning of the first period, we hit 0. Then the net profit, we hit equal to. Then let's go to our income statement and get our net profit. So hit right up here, hit equal to, and let's roll through. Absolutely. Then for the dividend that was expected to pay, let's see whether we've got it done already. So dividend is expected to be 3% of our net profit. So 3% of our net profit, So how do we do that? So we hit right up here, equal to where is the net profit, and the income statement, let's select the net profit and hit multiplication sign, this, and let's take out the pop-up, divide by the percentage of the dividend. Let's hit it. Good. So this amount that is expected to share to the shareholders as the dividend to pay. So now let's run it through. Exactly. So we are taking it to the schedule. So right up here, the dividend is equal to, let's go to the assumption, hit it up, hit enter. So right away, let's stretch. Good. And besides, the dividend is supposed to be in negative form because it's a deduction on the net profit to ascertain the retained earning for the period. So we put our minus sign right up here, right, take away the pop-up, that's not required, then hit enter. That's that. So let's move. Exactly. So now let's get to the ending period retained earning right up here. So let's hit our summation. So that's that. So the ending period retained earning here will be the opening retained earning for the next period of 2027. So we hit right up here, hit equal to, then take this up, hit enter. So that's that. So now we can possibly drag and have what is required. So good. So let's observe, as you can see, the ending retained earning here is the beginning right up here. Exactly. So this is the net profit for the different period. So the ending retained earning here is the opening retained earning here, and also likewise here. So that's that. So we really dealt with the schedule right up here. So now we can populate some of those areas we highlighted. So now we can return to the first sheet income statement. So we are still having the depreciation right up here. So now let's impute it. We hit equal to, then to the schedule. So right up here is the depreciation. Let's use the one in brackets, negative. So we hit enter. So that's that. So right away we've done 100% with our income statement. So as you can see, everything is way intact here. So these are our original net profits for the various period. So let's move on to the next, the balance sheet. So let's see where we need to populate as well. So we need to populate the cash, which will be done as soon as we ascertain our cash flows. The property, plant, and equipment, we already ascertained that. So let's put it, let's hit equal to, then our schedule to the property, the PPE schedule. We hit up right here, then hit enter. So that's that. Good. So now let's take out this. So we're done for that. So what next on it? So we have our retained earning for the various period. We hit our equal to. Then what's next at the schedule? We take up our retained earning right up here. Hit enter. So that's that. So let's take out the field. Good. So let's ensure that we add up everything. So from here to here, let's add up, ensure it's been add up. Okay, it's already add up. So let's roll through, certain is done. So for this, the total asset this plus this will give us the total asset. So how do we do that? We hit equal to, tap on this, plus, now let's take away the pop-up, plus this, gives us this. So now let's roll. That's that. So let's move on to the next. So the next are our current liabilities. So let's see what we have over here. So these are accounts payable and the rest. So let's see. For sure, the summation has been done. So let's ensure that everything are right. Good, absolutely. So for the long term is up here. Then the equity from here to here, right up is done. So for the total liabilities and shareholders equity, so we are adding up everything right away. We hit equal to, then our current liability, starting up from there, current liability plus, let's take away the pop-up 2 is uninvited, then plus the total long-term liability plus, take away the pop-up of 2 that's uninvited, the total equity right up here. Let's hit enter. Good, that's that right away. So what do? We just stretch out immediately. So that's it about it. So we're almost done with the statement of financial position for this. So right up here we are moving straight away to the cash flow right up here. So here is the cash flow. So how do we do that? We are forecasting as much for the 4 period. So the statement of cash flow is a schedule, right, that shows the inflow and outflow, the movement of cash in the business or within the period being forecasted, right? And it's divided into 3: the operating cash flow, the investing cash flow, and the financing cash flow. Basically, the operating cash flow involves the operating capitals, right? That's the current asset and the current liability. So these are all the items that are involved. So how do we do that? We bring in the net profit right away because it's an inflow of cash to the business. So how do we do that? We put our equal to right away. Then our net profit, where do we find it? It's in the schedule. So net profit is up here, it's equal to, then let's have it up. Good. Then the next one, depreciation. So this schedule is all about stating the actual movement of cash in the business. So basically depreciation is not a movement of cash, right? It's rather an assumption of expenses, right? So we are bringing it back, the value back. We hit equal to, let's go to the schedule and bring a positive depreciation in there. So now let's hit up, enter. So that's that. Good. So right down here is another interesting one, the current assets. So you basically know that current asset has a way it holds up, ties down cash at the moment. For instance, if you're having inventory, it implies that a cash is being tied for that period. So it's expected that by the next period, that current asset is being transformed. So how do we replicate that here? We do that by subtracting, right, the following year's current asset from the first year's, because we are trying to tie up as it is in the real life, the tie up or acknowledge the tying down of cash, right, while current asset exists. So the inventory has a way that it's put out cash aside. So now let's hit enter right up here, hit equal to, then let's return to the balance sheet. So how do we do that? We are starting from our projected 2025 to nothing was there as balances, but we still put that into consideration because those are the modes of operating or constructing 3-statement financial modeling. So there must be a preceding year. It's either with value or none. So we select the 2025, then we assume that the amount here is being tied up. So now we use minus on it. minus, right? Let me take away the pop-up, right? Then minus the next year's, which is 2026. Let's hit enter. You see that it's negative actually, because the cash is not ascertained. So now let's format it to be the way we need it to be. Right up here. Good. So the subsequent ones, the receivable and prepayment, falls under the same treatment. So I don't need to do them separately. So now I use relative function on them. Absolutely right. So I don't have to do them further because these are current liability. They have their own way of sorting for them. So how do? I hit up here. This time around is going to be the negative opposite of what we did for the current asset. So I hit equal to, right? So the implication right here is that liabilities has the way it makes cash available, right? For instance, if you purchase an item, if you don't pay instantly, expecting to pay at the next period, it means that the cash being expected or that was meant to be paid out to vendors are retained. So it implies that for that period, a current period, you have retained the cash that will be paid in the next period. So how do we do that? So we go to balance sheet. So we go to the second period, the next period, we subtract the last period from the current period. So here are the items of current liabilities starting with payable. So this is 2026, we hit it, then minus, let's take away the pop-up, minus 2025. So this is 2025, let's hit enter. So that's that. So getting one right, all things are sorted. So let's take advantage of relative functions. Okay, that's that. So as you can see, we are having all positive in the current liability because they have a way of making cash available in the business. So right up here, let's add up from here to down up here, let's hit summation. So that's that. Now let's roll forward. Exactly. So what next? Let's move on to the next. Property, plant and equipment. So definitely we capture those items, those property assets that was purchased at each period. So how do I do this? Hit enter, equal to, let's get to our schedule. So let's select what items. We have the items we purchased for the period. So these are day 2026. We actually bought this. Let's hit enter. And definitely they will be negative because they have a way of putting out cash, right? So this is it. So let me put minus to make it negative. No. So put minus, take away the pop-up from my keyboard, then hit enter. Exactly. So that's that. So let's move on to the next. So we're coming to the end of this in a short while. So let's see the long-term debt. So as well, we're going to apply the same thing we applied on liability, right? So we hit equal to, go to the long-term debt, we select, okay, let's scroll down so that we find it. It's right up here. Select this year minus the previous years. So put your minus right up here. Let me take away the pop-up of 5. Then minus this. Let's hit enter. So that's that. So let's go. Absolutely. So for the common stock, we also apply self method as well. We hit our equal to. Go to our balance sheet, the common stock is right away here. This here is minus the last period. let's hit enter. So that's that. So let's see what we have. Absolutely, let's get it formatted. So for the dividend, definitely it's taking out cash, so it's going to definitely be in negative form. So I hit my equal to, then to the schedule where we have it. So it's right up here in negative form, so I hit enter. Good. Absolutely, I think we've almost run this off. So right away, let's put down our total financing cash flow. So let's do that. Sum of this and that. Let's hit summation. Right away, is our total financing cash flow. So let's roll through. Absolutely. So that's that. So what is remaining here? The beginning cash flow of the year. So like I said earlier, there was no beginning cash flow for the year because this is a startup. The forecast was from this year, 2026. So the previous years, there was no activity. So how do I do this? I hit up 0 here, 0 because nothing was in here. Then they change in cash. Right? A change in cash flow, which is the activities this year. So how do I do that? I hit equal to. Right? Total operating cash flow plus, take away the pop-up of 2 here, the property, plant and equipment, which is a negative, plus, take away the pop-up, my keyboard is getting something wrong, then the total financing cash flow here hits equal to. So that's that. So adding up here to get the ending cash balances for the year, I put summation. So that's about that. So for the beginning cash flow of next year will definitely be the ending cash of this period. So I hit equal to, I select this and hit enter. That's that. And for the change here, I take advantage of absolute, I take advantage of relative function. So that's that. As such as here, also I take away advantage of relative function. So it's 0 because nothing has been here to populate them. So right away, as I make this stretch is being populated. So that's that. So we almost come to the end of this class. So now we've ascertained our cash balances for the period we've been projected for. So right away, I'm taking these balances to our statement of financial position to see if we have a balanced statement of financial position. So let's get straight into it. So I hit my balance sheet. Then let's go up here. 2026, let's hit enter. So let's take the amounts in the cash flow. Let's hit this. Bam. Let's see whether it's having balance. So right up here, we are having absolute balanced. Yeah, as you can see, the total assets, 1,163,756,626, as such as our total liabilities and shareholders' equity. So it implies we had everything figured out right. So now let's move way forward. Let's see how it appears in other years. So right away, we have total asset here. So we have equivalent right away. So everything went up, right? So for the sake of clarity, let's put up check here. C-H-E-K, right? So let's put up check. Let's have equal to our total assets minus, so let me take away this pop-up that's stubborn, get it off, minus our total liability and equity. Let's hit exactly, so we are having 0 here. So let's stretch. Good. So it implies that everything balanced. So we had everything figured out well. So now let's tweak 1 or 2 things so that you see how this thing works, because they are connected. Is the fact that they are connected. So you can decide to try out a whole lot of assumption depending on what you are projecting for. So let's have here cleared up, right? So for the income statement is cleared up, everywhere is cleared up, right? So the balance sheet cleared up, schedule is right up here, cash flow as well cleared up. So now let's put up some assumption right here. So let's assume that we needed more net profit. How can we do that? Is we can achieve more net profit by projecting more sales or increasing the prices. For instance, let's assume that the prices of the item is 10,000. Right, this is 10,000. You notice the change, the impact here. So let me note here is 20,000. You notice the change, but for the fact that it's connected and everything is made right, the balance sheet will still balance. It will just be projecting or depicting the figures, the assumption that you are making. Right, the reflection of every assumptions will appear in all of the statements. So now let's assume that this becomes 25,000. Right, let's hit enter, see that, and now let's the one become 40,000. So now there will be absolute increase in our net profit, as you can see, and also increase in our cash flow. Right, let's put 40,000. 1, 2, 3. Exactly, let's hit enter. So right away, you notice we are having inflated net profit right away. So we are having 14 points. At the end of the period, we are amassing 101 million points. Right? So right up, let's go to our balance sheet. So everything will still remain intact. You see that it's still having balance. So, but this time around, we are having way more cash. You notice our liabilities and equity share is increased. So let's go up here and see our cash. You see that we are having more bunch of cash right away. So this is how it works out. So now let's tweak 1 or 2 things here at the assumption on the profit of the statement of financial position. So for this right here, let's assume that we have 10%, right? Worth of payable in the first period. The implication of this is that there will be more increase in our cash, right? So let's put 20% here. So whichever number, what you put, 25%, 24%, whichever thing, everything will still go up well. So you notice there's extra increase in our cash. So that's that. So you do this depending on what you are trying to project or simulate or what you are expecting, so that it will give you the required outcome, right? Exactly. So that's this about this. I hope this class make a whole lot of sense. So that's that about 3-statement financial modeling. So you can actually tweak this thing according to the way you need it to be. So, but one thing most important is to understand how to make all those entries, how it's being structured, because if you have it right, it's right already. So every numbers you can use. It's not necessarily that you use percentage, but percentage are more definite at times than using just direct numbers. So that's that.